Um, so, uh, Sherry, why don't we start with you? Can you tell us a little bit about yourself, what your role is and what you've been up to?
Sure. Thanks, Igor, and thanks for having me. I appreciate it. Um, I have been in the business. I started out right out of college, and I'm currently a brand ambassador at iCapital. I could tell you a little bit about iCapital if you're interested a little bit later into it. But it's a technology platform that really facilitates access to alternative investment transactions and supports the whole process, including portfolio optimization and education. I started my career in private real estate and then moved into equipment leasing. Kind of have gone through the whole gamut, investor services, analyst, and then found myself more in the due diligence compliance space. And after 15 years, launched AI Insight, which was a database platform on private investments, non-traded investments, trying to facilitate access to that information with a foundational goal of consistency and transparency and documentation around fact-based information. So allowed advisors to say, okay, I get that really great, important information from a wholesaler or a fund sponsor, but I really want the ability to go in and do side-by-side comparisons on the facts or the investor disclosed information, so I can help make sure that I understand those. Plus, I can facilitate the regulatory requirements around offering complex investments. Sold AI Insight to iCapital back in 2021. And both of us tech companies looking to increase efficiencies and grow this space. But my most recent chapter is really about commitment to the power of private capital, and specifically looking at the ability for us to have an impact in what we do, increase the access responsibly so that we can have a greater impact, and look to the next generation. So that's a little bit about me and where I am right now.
Thank you, Sherry, for that. It's a very unique career path, I would say. Um, Jeff, you're up.
Yeah, well, it's always a privilege to be on a call like this, and I hope my excitement and passion isn't salesy, because that's not what I meant to be. But let me give you a little bit of my background, because I made a major transition about 10 years ago in impact investing. And so let me just give you, I'll do this in kind of three quick segments. So I been in the industry for about 26 plus years. Started at a company called Van Kampen. And one of the questions when I was at Van Kampen that was being asked, so this would have been in the mid 90s, was will people actually invest in a static portfolio of stocks? And that, when I was there, we were selling unit investment trust, UITs, which were the precursor to ETFs. Okay. So long story short, I'm sitting at the front of this whole wave that, of course, nobody knew it was going to be a wave at that point. And fast forward, we now know that trillions of dollars will go into baskets of unmanaged stocks. So I got to watch that happen at the forefront of that discussion. I left that industry or unit investment trust world in the end of 97 to go to an alternative investment company called CNL. And I'll cut to the chase there. I spent 20 years there, and I would pay money to go back and do it again, because it was an absolute case study. And the fundamental question that was being asked back then was, why would you invest in anything other than stocks and bonds? And you got to, on paper, you got to remember, I left in 97 to go sell real estate and that kind of stuff. And it's like, why would you want income in your portfolio from real estate? I can get 15% a quarter sitting over here in the NASDAQ. So that question was answered. In fact, one data point for you: when I joined CNL, the industry did about $750 million of sales. Today, I think the alts industry, that same kind of industry, probably will do $100 billion in alternative investment. So it's exploded. Well, neither of those two did I make cognizant decisions going, hey, this is where the puck is going. I did make a cognizant decision, so we'll see if I'm right or not. 10 years ago, when I was an executive at this alternatives company, and I won't go through the story right now, but I'll just tell you, light bulbs went on for me after a back surgery where I saw the world differently. And I said, wait a second, capital has power. And what if you combine a head and a heart in in investing? What can that do? So that well before impact investing was vogue, I stepped down as president to go start Common Good, which is what I do today on impact investing. And the fundamental question that I think is being answered right now is, and you can answer the question multiple ways, but it's, will people invest bringing their values into the investment process? 10 years ago, big question mark. Today, that question is getting answered. And I think it's absolutely going to go that way in a big way. So anyways, that's a background for me, but I come from 20 plus years, 20 years in traditional alternative investments. And then the last 10 years at the last 7 years roughly at Common Good, we help source, due diligence, and connect registered investment advisors to private impact funds, asset managers. So that's our whole business. That's the whole second half of my career. So being on a call like this is exciting because it means that there's momentum happening.
Thank you for that, Jeff. And I think that's a good segue into our first question for the both of you. So alternative investments have made huge strides, especially lately. But for a lot of advisors, it's still a big sort of question of why alternatives should be part of clients' portfolios. Could you give us an idea? Well, first of all, what alternatives actually encompass and why advisors should care about alternatives, and then specifically within impact space where that is. Sherry, would you like to start with that?
Yeah, sure. And I'll also add that Jeff and I have known each other for a really long time, and Jeff was really the person I've been talking to over the past 7 years saying, how do we bring impact investments? I've been much more involved on the independent broker-dealer retail side. And that was because AI Insight really helped on the compliance and regulatory side, which is heavier with FINRA. But for years, we've been saying, how can we get this into the space? Because it's something that we've both been really passionate about. But Jeff is so much more embedded and knowledgeable. And I'm just feel really lucky that I'm starting to get my feet into this space because it's something, as Jeff said, that's passionate and makes such a difference. But so what constitutes a private investments? So you've got, private capital, private credit, venture capital, real estate, real assets. We even started looking at, the categorization around alternatives that were publicly traded, but they're still alternatives. So it's a big basket, but largely what products have not necessarily liquidity, right? So that's kind of been something that they've been tagged with, although there have been solutions that are helping to assuage the illiquidity. And the approach has really been, how do we go ahead and have a long-term strategy and integrate these into an overall portfolio strategy? There's a great article that came out in August called Are You Harnessing the Growth of and Resilience of Private Capital by EY. And if it's something, we can send it in the chat later. But it talks about the size of the market right now. They said it was about just under $23 trillion in AUM at the end of 2022. And the 10-year performance on the private markets has consistently been stronger and less volatile than that of the public markets, especially since 2016. So it's a market that's growing. It's almost doubled in its growth over the last 2 decades relative to the public markets. More and more companies are staying private longer. So there's a lot more strategies that you can get into that you can't necessarily get into in the public markets. And I think that even though it's a little complicated, ESG obviously has been something that a lot of people have talked about. It's largely associated with the public markets, but the private markets and impact is something that I think we can separate because it doesn't have the opportunity to be politicized. It's very intentional. It has the opportunity to, in my opinion, kind of be the poster child for private capital investing, where you set out and very, very much from the beginning say, okay, here's a private investment. I'm going to be very intentional in my disclosure around what I want to achieve, both from a financial perspective and from an impact perspective. I'm going to commit to that transparency and disclosure, and we're going to be long-term partners. And that's something that the private markets have struggled with a little bit, right? I mean, so I think it's such a great time to be looking at impact. And I know that Jeff and I are involved in a lot of associations where we're trying to work with the regulators to say, hey, let's do this right from the beginning. Private capital has the power to do so much, because we know so much of the money is kind of moving out of the institutional space into the private space in terms of availability of money. And we just want to do this right. So I think if we all work together right now to say, okay, we know that this is growing, and we want to commit together to saying that transparency, disclosure, education, all those good things are going to help us be very successful in the impact space.
Yeah, can I add maybe just a couple of comments? So I think from where by the way, you did a great job explaining that. I think from where I sit, one of the things I would just emphasize is that private investments, private capital markets, like why they exist, it's not just somebody created this so that there's some new thing to sell or allocate to. Countries would love to have robust public markets, but they also would love to have robust private markets, because just there's so many things that do not get funded through public securities, or whether it's bonds or whether it's stocks. And so, and I'm really jumping in your camp on this one, Sherry. The idea that we as investors can invest in real estate deals, private credit deals, private equity, which private equity is just public or just stock, but they're not publicly traded. Like, it is an amazing opportunity. And investors around the world would love to have the opportunities we have here. So know that it's not just created as a marketing tool. Like, this is a legitimate market that needs capital, and you and I need it in our world to move us forward. And then I'm just a simple guy. So here's how I would describe, just to categorize it. Well, one answer is, and this is a bad definition, alternative investments is anything that's not a stock and bond. You'll hear that. But really, if you want to just go high level, it's real assets, which could be infrastructure, which can be real estate. It's private credit. It's lending to non-public companies. And then it's private equity, which is in being a stock investor, an equity investor in private companies. And then venture capital, which are startups. I mean, high level, if you just think about it, those are the big buckets. And then I was add one other thing: impact can go across all of those. So it's not that impact is some special category. It's taking an impact mindset, which we can talk about if we have time, to each of those asset classes. Generally, most people would agree with that. So if you talk about that's that way, 95% of people can go, okay, I get it. That makes sense. So anyway, just a couple comments to add to what you shared.
Well, and I think that's a good point, because really, if you think about the private markets versus the public, it's a funnel. I mean, almost all companies start private and then they funnel down, and then only some of them end up as public. So the universe of private companies is so much bigger.
So much bigger.
And a lot of the very large institutional money managers and asset managers, whereas they used to always say, oh man, I want to go public. A lot of them are saying, I'm not so sure. Maybe that's not the way to go. And so you're getting these unicorns, and you're getting these amazing companies that are private, not public. So it's really a shift, I think, in the whole marketplace. And from an impact perspective, it's a time for us to say, okay, let's just up our expectations and say we can not just, make these all about making money. We can make money, and we also have the opportunity to have some other expectations that we're going to ask of these fund managers. And through private investments versus public, which can get kind of complicated, right? Because of the shareholder obligations, you can say, I know exactly what I'm investing in. I can either invest or not. It's not going to get muddled up in all of that other stuff. So there's just I think, an opportunity for clarity if we all do this together responsibly and understand and educate, do our due diligence and all the things that we should be doing anyway.
Igor, can I take a minute and just describe generally accepted what impact investing is?
Yeah, absolutely.
Okay. So again, I'm going to give this definition has been codified. And if I remember the math right, I want to say impact investing, the term came out in 2006, somewhere right around there. Essentially, it is this idea of investing for return and a social or environmental impact as well. Generally, you're going to hear 3 or 4 different axioms that need to be followed to fit this. One is there needs to be a return. If there isn't a return, then it really is charity. And by the way, you can actually put this on a spectrum, but there needs to be identified what is the return. Sometimes it's concessionary. You're not trying to drive market returns. On the other time, it's, hey, we're not only trying to, we're actually trying to beat the market. So one is there's a return component to it. A second is there's an intentionality, meaning there's an intentionality above and beyond just financial metrics. And so what that goes to the third part is there are goals that you are measuring and that you are trying to improve upon. So not only will you have financial goals, but you will have non-financial metrics, whether it's social, whether it's environmental. And then the key is you need to measure them. You need to report out. Like any investment, there's times when clearly the returns are where they're supposed to be, the times when they're not. You got to adjust. Same thing on the impact side. You could be shooting for certain impacts, and you may not be delivering them. So you've got to be honest with the shareholders and go, okay, we're not here. We're going to tweak this to try to get this. So, and then usually there's this idea that it's sustainable, meaning it has a track record to not in performance. I mean, it has the ability. It's a viable model that can go on. Generally, that kind of sums up with like, what's the difference between an impact investment and a non-impact investment? And oh, by the way, some of this stuff, every business that you invest in is doing something. But I will tell you, as sitting on the investment committee for $25 billion of stuff we've bought in my past life, great people. And I mean, they're great people, but were they specifically putting in impact metrics? Not really. So there is a difference when you get in there. So anyway, high level, that's what I would say from an impact. Where ESG is generally done on public companies. It's generally about process and procedures around environmental, social, and governance. For what it's worth, I actually think you're going to start to see ESG even start to be more outcome-based, like impact, because it eliminates more of the noise to say, hey, we're trying to drive this and make this improvement. Either we did it or we didn't, and how do we change it? And I'm not hiding you what our motives are. And so there's a little bit of that in the ESG where there's just, it's uncertainty of, well, this one measured it this way, this one measures it that way. So not beating up on ESG, but I think that this outcome-based, I think you're going to see ESG start to be a little bit more that way.
Yeah, thank you, Jeff. I guess it is important to understand the difference between impact and ESG, and there's a lot more we can say about this. And you guys have given us a lot to work with. So let's try to dive into some of these details. So within the alternatives, I think the biggest portion of that is the private real estate. And within that, one of the obvious sort of impact investing themes is affordable housing, which is, Jeff, what you and your company is doing. I think most people intuitively understand what affordable housing is, but give us a a definition, an introduction into that, and tell us how how impact actually lives here with the with potential profits, with the intent of financial returns. Frankly, myself and a number of my colleagues that I've been talking to over the years have a hard time, or in my case, had a hard time understanding how the process works. So Please, help us go through this and explain how it works.
Yeah, so I gotta step back. So when I was 40, I'm 50. When I was 40, and I had this back surgery, when I was the president of this company called CNO, doing all this real estate and whatnot. It was 5 weeks after my back surgery, and I plugged in a DVD of an investment opportunity in the Southeast, and it was affordable housing. And I'll touch on it in 1 second. But here's what hit me was not only the competitive returns that were possible. I will tell you, I made the investment. It performed phenomenal. But ultimately, what really the light bulb went on for me for impact, which is ultimately why I left that company eventually, was two residents at these properties spoke for 20 seconds each. You know, it's obviously a video. And one of them said they were comparing what it was like to live at this apartment complex prior to this group coming in, buying it, fixing up, and putting in new management. And one of them said, they've given me my dignity back. And you're like, ooh, that's pretty powerful. And another one said, I'm so excited to have people come to my house now. And I knew what they meant, but I'm like, these are apartments. And here's what hit me. When you combine an investment mindset and bring in some heart into that, you have the ability to not only impact these residents in this case. One of the interesting things for me is we made this investment. And for the first time ever, my wife was now engaged in what we're doing, because it was like, oh, we're making money and we're helping these people. So that's how ultimately I made the transition. But specifically on affordable housing, when you hear the word affordable housing in the general marketplace, it's a misnomer, because what they're talking about is they're going, it's just cheaper housing. Well, when you get into the space, there is two things you know. There is affordable housing with a capital A affordable housing. It actually is a definition. It means something. It doesn't just mean cheaper priced. Workforce housing, or often it can be called naturally occurring affordable housing. So you'll hear it called NOAA, natural occurring affordable housing. That is just cheaper priced housing. Okay. So when we say capital A affordable housing, what does that mean? It means that those are probably developed with tax credit dollars, something you and I are not going to be able to participate in. Banks, insurance companies do it, and the government has these programs set up because there's a massive need to build these things, and they give them tax credits to do that. But in order to get those tax credits over a 10-year time period, essentially they have to be occupied at a certain level. They can only rent to residents who make less than, generally, 60% of the area median income. So they take that area, figure out where the average income, the area median income is, and say, well, you have to rent to people that fall below that. And then the rents that they charge, it's not a free market rent. Now, it's not willy-nilly. There's a HUD agencies that decide each year how much you can charge for those. And generally they go up 3 or 4% a year. But it's not where you could, because here's the problem. If you don't have that in place, guess what everybody does? They buy them, fix them up, kick everybody out, and charge more. So that is affordable housing. Now, let me be clear. How would you as an investor invest in that? You invest in these properties after these tax incentives are gone. So you're buying them when they're 10, 12, 15 years. But what is massively needed in this industry is capital to go back in there to fix them up, to infuse them with life, and yet still keep them affordable. So at that point, you're evaluating it just like you would any other investment. You got to make sure that the rents work, that your expenses. The only variable you got to remember is you can only charge so much rent a year. So you have to be very thoughtful about how you spend money. Otherwise, you're going to lose money. Now, let me just tell you, and this is not a sales pitch at all, but let me just, so you understand, if we were to go buy one of those properties, well, let me step back. You cannot, there's not enough money to develop these properties to make a dent in this space. So it's like 100,000 are built every year, but about 100,000 become obsolete every year just because of wear and tear. So you have to have money coming in and investing in these properties so they can go another life, another chapter, and go on. So here's how we think about it. And generally, you're going to see this in industry. You go in and you make physical improvements, put new roofs, all this kind of stuff. You're going to freshen it up. Now, you got to be mindful because you can't put too much money in it. And I'm not going to go through all the details. The second thing is you're going into the property and optimizing it. You're going in and looking at, you're doing energy audits, you're doing water audits, and you're making all those type of retrofits need be that are great for the environment, but frankly, you also get a return on them. And then the third piece, this is really as an impact investor, what we and others do. We surround, and people do it differently. You surround these residents with different nonprofit organizations to come in. They call it resident impact, to come in and to help them with English as a second language, or a food pantry, or I mean, the list goes on and on and on. What you find out by loving and serving these residents, they're sticky, they stay, they keep, and when you own these things, one of the worst things that happens is people leave and you don't have rent. So clearly the heart, and I've been on many of these properties, the heart of the management is for these people when they save enough money to move on and to go to a home or whatever. But a lot of them just are not going to be able to. So, but they have become loyal residents and they pay and pay and pay. So that's what affordable, that's the investment side on affordable. You also can take that same strategy and go to workforce housing. The difference is there, the residents generally make 80% to 120% of the area median income, and it's free market, but it's free market rent there. So depending on how you want to play in this space, it's funny, people say, oh, I don't believe in workforce because they have more money, and so I really want to go up to affordable. The truth is they actually look at affordability. They're burdened across workforce and you're burdened across affordable. So part of it's just, where do you want to invest? So that the high level, that's how you would invest in affordable housing. But you analyze it ultimately just like you would any other investment. But here you're trying to infuse you're trying to upgrade the property, you're trying to make it more energy efficient, all that kind of stuff. Frankly, like solar panels would be great, but you got to be willing to hold that investment for probably 10 plus years. And then you're loving on these residents with all different services.
Well, I think, if I can add one thing, Jeff, because I think that's so great. It's such, that third piece, that value added piece, the intentionality piece, is going out and helping to create a true community, I think, for people who in the affordable housing space oftentimes don't have it, and building in those services that help them be successful, if they lost a job, instead of kicking them out, you go and say, hey, what's going on? Can we give you some support around building a resume? So like you're talking about the stickiness of an investment, which is so huge, and it just has this infused piece of humanity that is like, hey, we all win. We all get out there feeling better, and we're doing a good thing for this and building this community of people who are typically fragmented. And so I just think it's amazing. I love how you describe it.
And you would see it in person. Like if you went, because I've been on multiple of these, and I've in my old life, just traditional multifamily, like the way that they treat the resident, without going there, I might explain it. It's different. I mean, there is a real passion to help these people out. One other thing I should note, in affordable, capital A affordable, one of the things that you can have, and frankly, a lot of our properties we get, and I'm going to use a term that's not really used, but you'll much anymore, Section 8 housing. They get vouchers. So in like some of our properties, 60% of our rooms are actually Section 8 vouchers. That actually provides unbelievably stable income. And then the way that they're structured generally is as rents go up, it really doesn't get passed on to the resident. It gets passed on to the government in that regard. There's some formulas there, but it helps offset and makes it that much more a secure investment, unless you believe or are concerned that the government's not going to pay for that.
And if I can add one other thing, what I think is really cool, you talked about, the ability for your wife to get interested and what's so important now, not that we want to minimize any investment, but we all know that the ability to tell a story is so valuable. And so what better chance to tell a story around an investment rather than, okay, let's talk about the financial, because we got to put that on the table, and we're not going to have a conversation until that's clear, right? If anybody's familiar with Maslow's theory, right, we're going to just make sure we've got that bottom financial needs met, but we're having the opportunity to bring people up into something that's much more meaningful after we've, taken that financial piece off the table, because it's a given. I mean, we're not investing unless we're going to make money, and we've done all of that due diligence to make sure it makes financial sense. But you as an advisor now have the power to go to these fund managers. And this is something that I'm looking at with the Leaders in Collaborative Impact piece. That's my next generation. We will influence the future by asking the right questions and demanding that, hey, this is equally important. And so, we have this opportunity to play a very active role in saying, okay, where do we go with private capital in the future? Tell me how it works, but I'm going to start asking some of these questions. Tell me, what do you do? Like, tell me your strategies that go beyond the same old strategies that I've come to expect for a successful investment, because I want more.
And to that point, and again, this is not to speak ill of public securities, because I own them and I've been there.
Yeah.
One of the attributes that's so unique about private investments is it's easier for people to, especially in the ESG impact, and again, I'm going to a crude analogy. In the ESG world, I bought Coke and sold Pepsi, for whatever reason. Like, that's just harder for most people to connect with, versus I'm investing in renewable energy, whatever, in Africa, or I'm investing in housing, and here's a story of a resident, what we did. It's just easier for investors to get connected to it. Now, you still need public security. So, but it is a unique attribute to the private impact space.
Yeah, and we've trended towards saying, and this is just again with the Leaders in Collaborative Impact, saying SDG goals, because it's, impact investing can be anything that's important to you. And that's how you get away from like siloing yourself into saying, oh, you're just an environmentalist, or oh, you're just a bleeding heart socialist, or whatever. The UN came up with 17 sustainable development goals. There is something in there for everybody. And it kind of, I think, takes away the trigger. So we're just kind of calling them SDG goals, sustainable development goals. There's something in there for everybody. And that's the impact piece, which is private. You go find it, you ask for it, and you invest in it. And there's clarity around that. Whereas it's a little harder when you've got the public funds that have a lot of different things in the mix. And then it makes it harder to have that clear path.
That's great. I think that's a great introduction in affordable housing, and thank you for all your thoughts on that. And by the way, just a reminder, if anybody has questions, feel free to type them into Q&A. We'll get to that. I'm cognizant of time, but we'll just proceed with our questions that we had so far, and if we have Q&A at the end, we'll leave a few minutes for that. So beyond affordable housing, obviously there is a lot more in impact investing. So renewables is obviously a very big sector, and both in public and in private investments. So Jeff, I know your brother is involved in renewables. Yep. And this is another topic you want to talk about. So why don't you tell us a little bit about that sector specifically within alternatives, and how the alternative investments in renewables are different than many potentially available investments in public markets?
Yeah. So what I'm going to do is I'll give a little bit on renewables, and so we source and due diligence all different type of impact funds. So what I want to do is just paint a brief picture of several of them that we're looking at, just to kind of intrigue your imagination. So one of them is we help raise capital in a company called Fortiscreen. It's actually a fund. They do renewable energy in Africa, select countries. Just a couple stats for you. 600 million Africans do not have access to power. They're about 1.2 billion. So half of Africa does not have access to power. And the downstream impact from that, I won't go through them all, but you can imagine, from education to healthcare to running businesses, it's massive. The world knows it, and you have these, China and others who are pumping, into these projects. but they are these small scale renewable energy projects. And in fact, if there's a way, Igor, I'll send you a link to a video or two so people can see them. So contrary to like your mind, this is not charity. This is providing the most economical way to provide power to these people, and it happens to also be the most environmentally friendly. So one of the assets that we buy in that fund is called run of the river hydro. So you basically take a small river, or it can be a big river. You don't dam it like the Hoover Dam. Instead, you dam it to divert the water. So if a river's like here, you divert it, and then you take the river through this diversion to its highest point. Then ultimately you run it down through these huge tubes, and then it goes through a turbine, and then it sends power out to the grid, and then that water goes right back into the river. Just to give an example, and this is again not a investment pitch, you can generate 15 to 20 IRRs on this stuff. And then the impact that it has to these communities, it puts power into the grid, but also what it does is it allows for the grid to grow out to these areas. So that's an example of what is available today. It's, when you hear Africa, you automatically assume charity, you automatically assume all this kind of stuff. No, this is frankly, you can probably earn about an 8% a year higher return. Now there's a risk premium. We would argue, you know what? I think we're actually getting overpaid for that, for another discussion. But like, those are real legitimate investments. It's a real estate play and basically you're getting paid by the power companies these 20 to 30-year contracts. So that's one, just to whet your appetite.
Sorry to interrupt you. This is the Hydrobox video that you're talking about?
Yeah, Hydrobox is the first investment that's one of the videos. Yeah.
Would you like me to share the link?
Yeah, that'd be great. Yep.
Okay. All right.
So this Hydrobox is the first investment in the fund. It will have 8 different assets associated with it. We're about ready to close on another asset. It's a run of the river hydro in Rwanda, which is where my younger brother lives. And then we'll just keep, and there's probably 2 or 3 others that'll go in there, and we'll just continue to build that. A couple other things just to know about: small to mid-sized enterprises. That's just the terminology that's used. Generate 90% of the GDP in the world. Massive, and because the financial markets are not as developed outside the U.S. as they are here, massive need for financing those companies. So that's a common theme in the impact space, is investing in these small to medium-sized companies. Typically, it's lending. Sometimes it's also can be an equity investment. And most of those are outside the U.S., but that's another big thing. You can actually then bifurcate it down and go, I really want to focus on women-led businesses. I want to focus on whatever. Another one that we're looking at is really interesting is, you all are familiar with the student loan crisis. There's an opportunity. There's a firm out there. We've been doing due diligence now for about a year and a half. They basically go in, and I'm not going to go through the whole thing, but they restructure these private student loans, which then puts them on a path that they actually can pay. Within usually 12 months, their FICO scores go up 125 points. Generally, there's a co-borrower on it, which is their parents. It goes up as well. And they go from like 10% interest down to like 3.5% to 5%. They do this by buying these loans cheap. So they have figured out a market-based solution for private student loans to come in and help. They're still going to pay, but they restructured all, because you cannot bankruptcy out of these things. And investors, meanwhile, have the opportunity to earn, depending on how long you lock your capital up, between 6% and 10% a year. So really cool market-based investments out there that make money and do good. And then the last one, and this is very niche-y. This is one of the ones near and dear to my heart. My wife and I have been investing in businesses that are either run by or hire formerly incarcerated men or women. I wouldn't suggest that to most of you, but I just want to show you that's how personal it can get as well. And there's a plethora of others. I'll leave it with this. In my 26 years of doing this, which I've worked with KKR and CBRE and these big behemoth companies, the innovation and creativity that I've seen in the impact space has been way more impressive than I would ever imagine. People think of impact as all heart. It's like, well, it's heart, but they know if you don't build sustainable business models, it dies. So this idea of how do you make money and do good? It's like, look, a true impact investor is going to do everything in their power to make it sustainable so they can have big, large scale change. So anyways, those are a few of the things. I'll try to send you a couple videos and you can also pass those along.
Great. Thank you. All right, well, let's try to switch gears a little bit. Let's talk about something that advisors have to deal with one way or another, which is compliance. And I know, Sherry, you have a lot of experience with it. Can you take us through what issues advisors need to think about in that regard, and whether there are tools that iCapital or other marketplaces may be providing to help ease that burden for advisors?
Yeah, sure. Well, thanks, Jeff, because this is not exciting, but it is really,
Oh, it's important.
Yeah, it's really important. And honestly, it's why I started AI Insight in the first place. You need both, right? You need to be able to understand the excitement of something and the story of it, but to protect your business long term, just like everybody has to have a sustainable business plan, you have to have a sustainable business plan for yourself, and that makes sure that you're doing things right. So as I thought about talking about it, I actually thought I would focus it on the 2020, the SEC 2024 exam priorities, and just kind of bullet through there, because if we run out of time, because this isn't exciting, you can always circle back. But there is a lot of attention on unconventional strategies, that are on the radar, and they always are, whether they're complex investments, but they're calling out private capital a lot. So I'm going to mention the first one because I just think it's so important. It's not necessarily called out this year or this coming year, but education, right? So first of all, we have to just take the common sense approach and make sure that we understand what it is we're selling. We understand the strategy. We understand how it contributes and enhances the potential portfolio for your clients. It's not just that exciting story. And that's a simplistic way of what they dive into. You have to understand what you're doing. And also, if you can't prove that you understood it at the front end, you're going to find yourself in a world of trouble later if things go sideways, because that's when your clients, no matter how great the relationship is, that's oftentimes when they'll come back, and the arbitrators will say, well, if you can't explain it or your client can't explain it, just don't even bother showing up, right? So really important, that education piece on the front. Plus, it just makes us much better people in our jobs. So let's kind of drill down to what the SEC calls out. They want to make sure you have the processes in place for making that initial investment and the ongoing suitability determination. So you have to make sure there's clarity around that suitability, that your clients, it's the right product for them. There's not alternative products that have a lower fee structure that can solve for that. So making sure suitability is the number one reason for any arbitration or any problem down the road. So making sure that your client is suitable, you're looking for the best execution. That's something they're going to take a look at. Make sure that you're identifying a partner. And you mentioned, iCapital is a technology partner, for example, just one that can help you reduce NIGOs in processing what is still a relatively heavy paper investment. It's getting much, much better, but the execution is still manual. You should probably consider having some extra disclosure documents that you have your client go through just to protect yourself and say, I understand. We've talked about all of these, special conditions around fees and structures and ongoing expenses, because those are the things that the regulators are making sure that are understood. Conflicts and controls that are in place, disclosures around private funds, and the ability to manage those if they have other registered investment companies, kind of how they're pairing. Some of these fund managers are going to have private investments and they're going to have registered funds, or they're going to potentially have affiliated service providers. That's something you have to really look at and understand, because they're calling it out to make sure there's no conflicts of interest. So have these conversations with potential long-term fund managers that you want to work with, and make sure that, again, you at some point in time talk about these potential conflicts with your clients, because that's what the regulators are going to make sure. If you're selling an illiquid long-term investment that they consider complex, They want to make sure you have these extra conversations. The SEC doesn't necessarily call it out, but I think in our experience, understanding insurance, having insurance is really, really important. You don't want to build your business and then have one footfall come through and you find out, oh, I thought I was covered, or there was an exclusion. So understand your insurance policy, understand what's covered, what's not covered, communicate accordingly to make sure that, if something happens, you have the insurance that you think you have and you don't find yourself without, because there are exclusions around some of the alternatives. And a lot of it is that the insurance carriers don't understand it either. So Jeff and I are actually going to be introducing impact to a group of risk managers and defense counsels on the RAA and the IBD side to say, hey, listen, we need to educate the insurance people so we can get the right coverage and just not have them say we're not going to cover it. And I'll close out with one funny conversation. When I started AI Insight, I think my son was 10 at the time. And I was trying to explain the complexities of alternative investments and what we do. And after the whole thing, he's like, oh, Mom, I get it. Show your work. So you have to make sure, right, that you just, all the things that great things that you're doing, all of the front end due diligence and compliance, you document everything that you're doing, because you can't come back later and say, well, I did that, but you can't show that you did it. So that documentation is so important to make sure that you're using common sense, doing your due diligence, and documenting everything along the way to show that you did it. Show your work.
Right. And so
not as exciting as the story, but help, we work on risk management and we work on kind of our aspirational goals, and we have to do the whole spectrum.
It's important. And on a related topic, due diligence keeps coming up in our conversation, and this is really the last question that we have prepared for today. And due diligence to me has two parts. One, I always wonder how fund managers, let's say for any of those alternative funds like affordable housing, how they do their due diligence. And from the perspective of advisors on behalf of their clients, what due diligence steps should they be taking? Jeff, would you like to start on that?
Yeah, I mean, we host webinars on this constantly, so this is a big topic. So I would tell you, I'm going to leave how the manager looks at it for a sec. Let me tell you how we look at it when we're analyzing managers. So one, we're going to look at, we call them partners, just because one of the things in the private space, we say you marry an investment because they're longer term. Whereas if you're in the publics, we call you dating, because you can get out of those when you want. So we call them partners because, so we're going to go in and analyze the partner. We're going to look at the investment theme itself. We're going to understand everything around that, and embedded in that is their track record. We're going to also look at the impact. We're going to make sure that, when do they bring this impact idea into what they do? Is it embedded into everything they do? And then we're going to look at legal and operational due diligence. That's what we think about when we do it. I mean, this can take us 3 months. It can take us 12 months, depending on what it is and where it's located. We will end up putting together a investment icon memo. So it could be 10 pages to 20 pages. And then we go through it as an investment committee and decide if it passes or not. And usually it's, hey, we got to get this question answered, this question answered. So that's how we do it, and that's fairly typical. As an advisor, just a couple things I would say. It takes time. Like some of the stuff we've been working on for 2 years, and until you get the fund gets big enough or till whatever. The other thing is I would say find partners. So I look at this group. Let me dream for a second, because frankly, why we create a common good was because this issue right here is very hard for people to solve. And so it's one of the things that we do, and I'm not trying to sell you on it, but a suggestion I'd give to you all is, if you all as a group could come together and go, hey, we want to look at this area and this area. So affordable housing and whatever, and renewable energy, just because that's what we're talking about. If there are ways for you all to collectively come together, hire somebody to say, hey, go do due diligence, you share in that expense, honestly, that's probably the best. It's probably the most cost efficient way for you. And it takes a lot of expertise to look at this stuff. And so I don't say that to be trying to sell you on anything. The reality is it just takes a lot of time to dig in. But saying that, I would ultimately try to leverage, you're gonna have to spend the time to do the research, and I would try to leverage other RIAs and other people that you know. We do it all the time. Like, I'm not fundamentally an expert 4 years ago on renewable energy, but I knew how to call a bunch of people who are experts in this stuff. So really branch out. To the extent we can help you, we do the due diligence on stuff that we work through. We're happy to share that with you. It's You're seeing the other way to do it is not to push anybody anywhere. Look, that's why there's these RIA groups that've got 30 RIAs, because behind that is a whole team that's doing due diligence on this stuff for them. So there's a lot of different solutions, and I'm happy to brainstorm with you if you guys have further questions. But I do appreciate the opportunity, and you're in a great spot. The two things I'll leave you with is this: somewhere between 70 and 80 trillion, I don't know the exact number of money that's going to transfer over the next 25 years. And what I do know is the next generation very much cares about aligning their values with investing. So the fact that you guys are taking the time on this call to learn, you are ahead, and I believe you disproportionately will serve your clientele even better.
Yeah. And I would agree, Jeff. And I think it's difficult because you're at the front end of this impact role. And if you're looking to get general education on the private capital markets, you can go, and again, I'm not selling this, I'm just trying to give you access to tools. There's probably 120 funds on the iCapital platform that you can access at no cost. Just register, go in, and it allows you to do some of these side-by-side comparisons. Get yourself some general education on the private markets. There's hundreds of different levels of education that you can access. There's product-specific education. There's another 375 funds on the AI Insight powered by iCapital. The ones that are on the marketplace come with due diligence if you want them. They come with sales support. They come with everything. But then there's a lot of smaller funds that are just coming with the education. But we don't yet have many impact funds. So you can kind of stage, if you're not really familiar with the alternative space and you want to get your feet wet and you want to see the tools, portfolio optimization tools, those kinds of things, we're looking at them. But we need people like Jeff, who are real specialists in this space, to dig in and find them. But it might be just a nice kind of staged approach to becoming familiar with alternatives and the tools that you can get at no cost, and then start, branching out and getting specialists like Jeff to help source some of those true impact funds. We'll put them on there when we can get them, but they're harder to get, and a lot of them are smaller. And so, you have to have, when you put it on a large marketplace platform, there has to be enough capacity to meet the demand. And so a lot of the impact investments, and Jeff, you can speak to that, are sometimes a little bit smaller. They're not these massive funds.
Yep. All that, it'll grow, but you're right. By the way, I put my email in the chat. If anybody wants to reach out to me, please do. Happy to have a discussion. Or if you want to be, we send out a monthly, sometimes more than that, monthly newsletter. So if you want to be on that, let me know. I'm happy to do that for you as well.
Great. Thanks for that, Jeff. And thank you. There's been a lot of great information. I apologize, we're a few minutes over time, but we have a few Q&A questions. So if you have a few more minutes, sure. I'd love to run this by you. So one question from Bob is about general minimums and fees and liquidity risk as they come with investing in alternatives. Can you give us some idea of what advisors and investors can expect?
So this is a longer discussion, but alts in general have a different fee structure, and the same thing be true of impact investments. So depending on if it's a real estate play, if it's a private credit play, if it's a private equity play, They all have slightly different nuances. Here's where I'll leave it for you all. Um, I would try to find an asset manager who prices this more institutional, because they're out there. And the nice thing about, and Sherry mentioned this, the impact space is still growing. So oftentimes, legitimate institutional managers, they may have a $50 million fund. You can bring them $1 million to $2 million. They want you in. You go into a traditional alternative investment that's huge, and you bring $1 million, they're like, I don't need you, and my minimums are too high. So you actually do have the ability to access some really good managers at good pricing. On the private equity side, it's usually 2% a year plus. There's a carried interest. It's a totally different model than stocks. Real estate maybe 1% a year, and then you participate in some profits as well, and a promote on the back end. So it's all over the board, but that's what I would say is look for more institutionally priced. Generally, you can find some stuff at $50,000 minimums. Oftentimes, though, 100 and up. And it's really because of the way the regs are written, because oftentimes you can only have so many investors. And so they don't want to have small investors because it takes a spot. That's one of the things that we've tried to solve at Common Good, is actually to go to these managers and say, like, for example, our affordable housing has a $50,000 minimum. Very, very hard to find that elsewhere. But anywhere between 50, which is the lowest, up to about 250, that's where the minimums generally fall.
And I'd like to think, Jeff, right, that's the history of private capital. That's where we started 25 years ago. And now we have registered funds where you can do it. So we're at the beginning, and hopefully in 10 years, hopefully we can accelerate it faster than that. We'll find greater ways to have access.
Yep.
Well,
ironically, the more investment dollars we get, the more you can change vehicles to bring it down to lower lower amount. Yeah.
Yeah.
Great. Thank you. Next question is from Matt. Sherry, this one is for you specifically, and it's about AI Insight website, where I guess he was looking at it, and he says there is you can find a way to screen for impact. Maybe there should be a category on the sector or objective step. Sounds like a technical question for you, but
yeah, and you can reach out to I put an email in there for education@icapital.network, and someone can step you through it. Interestingly enough, back when we started AI Insight back in 2005, we put one field that said, do you have a socially or environmentally responsible aspect to your fund? Because everything we did was prospectus or investor disclosed information. It wasn't marketing material. We still don't have a lot of people that put anything in there, but there is a way to run a report that will show you whether they say yes, and then to drill down. But because it's not something that's still, being marketed by these funds, it's a little hard to reach. So we can definitely help you get it. But if you reach out with that question, someone can hop on a call and show you.
Great. And we have one more question. And I know we're over time. If you have to go, just a reminder. So we're Advisors for Good. We will put you on the email list, and we hope you join us as we try to do similar events every 3 months or so. And the time in between, we may have also regular meetings and general discussions. So we hope that you like the event today, and you'll come back to us. So the last question really is about interest rates and the environment that we're in right now. And basically the question is, how does that impact risk and return profiles for impact investments that you're seeing in your spaces or generally?
Yeah, so we could talk about this for a long time. I would say, first of all, I'd say, and I got to think through this, but generally, as interest rates, first of all, let me say this. I don't think most people realize how much interest rates that have moved up this fast have really impacted the real estate market, for example. I don't think we've fully seen that yet play through. So that's true whether it's impact or not. What I would say, though, about an impact, if it's an impact investment, because return is one of the variables and it's key, and there's other variables that they're trying to solve, I've actually seen impact investors be more creative and innovative to try to solve these things. So I don't know empirically, but I would say I actually think when time gets a little tougher, I think the palette of tools that an impact investor can use, our asset manager can use, I'm going to bet that they can get more creative. I'm going to say that. I would tell you the biggest thing, we've seen it on the real estate side. For example, in affordable housing right now, prices they've come down, but they've not come down enough relative to where interest rates and what mortgage rates are at. So the transaction volume has slowed down dramatically. What that practically means is if I was buying a fund today, that's buying tons of real estate. Really hard to buy tons of real estate today. Well, go buy a fund that is hand selecting and can find some one-offs. Okay, that's a much better deal than these big massive funds today. Trying to think on any of the other asset classes. I mean, obviously, when you start getting into venture and that kind of stuff, interest rates that have moved up this fast, as quickly, massively impact them as well. So I think it'll be fascinating. I think, in fact, I wrote something recently. I do think that as investment advisors, we got to challenge, are the last 20 years going to be going forward? Are they the same economic drivers? And I think we have to think differently. And I think cash flowing stuff is way more important today. But those are just my random kind of thoughts for you.
Thank you. Okay, I guess there are no more questions. So again, thank you, Sherry and Jeff, for joining us and talking to us today. Thank you, everybody, for attending. Hopefully, we've learned something. I know I have. And we'll hope to see you again very soon.
Thanks for having us.
Thank you.
Thanks. Bye-bye.
Bye-bye. Thanks, Igor.
Thanks.